Yeah, I mean, to me, I think the biggest fear the market has is that the Fed has to keep going even past what is currently priced in the market. And so rate hike expectations have pretty much been on an elevator up. They've stabilized a bit recently, and we think they'll stay where they are right now because you are starting to see, despite the hot inflation print last week, you're starting to see forward-looking indicators of inflation come down. Contemplate that spot commodities are off 21%. That is set to have a pretty chilling impact on inflation in the coming months and should alleviate those fears that this is something like the 1970s where economic growth slows, but the Fed has to keep going because inflation doesn't slow with it.
Well, Brent, it seems like everybody in the market's looking at those signals and trying to be forward-looking about it and anticipate the turn in policy to accommodate that, and yet the Fed seems to be operating by a different standard, which is multiple months of declining inflation evident in the data itself. It seems to me that's the kind of the frontier of the tension that exists in these markets, where the market wants to get on with the next phase, and the Fed says we're not going to show any inclination to ease back until the numbers tell us to.
Yeah, I mean, the Fed is certainly trying to keep their inflation fighting credibility. They don't want to lose that. That's why they actually increased the pace, because they saw, for example, the University of Michigan 5 to 10 go up to 3.3%, which was ultimately revised back to 3.1. But the Fed isn't going to show their hand too early. They want people to believe that they actually have still inflation fighting credibility, because that's what they lost in the 70s and 80s. I don't think they're anywhere near that yet. And if you think about it, the Fed can pivot pretty fast. This has been a more nimble Fed than I think most of us are used to. We used to have the Fed that televised and then did exactly what they said they were going to do. Now the Fed is reacting to the data. That is what is creating the volatility that you're seeing. And I think it could be just as fast on the opposite side if you do see concrete signs showing up in the data. I think that CPI data kind of distorted things, that it shows that inflation is in fact subsiding.
Does that mean that you believe, first of all, it's obvious this Fed is more flexible than we previously thought, right? November of last year, we were talking maybe one hike this year. Early this year, Bank of America says 7 hikes this year. People thought that was nuts, and we're well there. But on the other hand, do you think the market can essentially absorb what's already anticipated? In other words, you said the big risk to the market is that people think the Fed has to go farther than what's already priced in. What's priced in? 3 3/4 on the Fed funds by the end of this year? Is that palatable to risk assets right now?
I think so. I think you've seen the market stabilize. I know it's been down a bit this week, but we're kind of in the same range that we have been for the past couple months. And that's largely due to the fact that we've kind of peaked on these rate hike expectations somewhere in the middle of June. Since then, they've come back and kind of stabilized. I think as long as you see that continue, I think the market has put in the bottom. I certainly don't think we're going to up and away and just fly away higher. I think you're going to see a grind back and forth as we kind of await each and every inflation data point. The good news economically, certainly we could have a recession, but I would think of it more as a buyer's strike, not necessarily a deep recession like we had in 07, 09, where consumers spent the next 10, 15 years rebuilding their balance sheet. Today, those are still in good shape. And so any recession would be mild, and the market, to me, has made its bottom and will push higher into the year end, but certainly not, up and to the right.